Hi, I'm glad you guys are here to learn about taxes. Taxes are always fun. I've got a few things up here. I've got these, the IRS acronyms. Maybe interesting to you or not. You've probably heard a lot of them, like AGI, you know, all the different things. Advanced Child Tax Credit, or CTC is Child Tax Credit. You know, just a lot of the things that the IRS uses. So if you see some of these on here and you have some questions, by all means say, what about that one? What about that one? I don't know if you've heard about ES vouchers, and how this stands for estimated tax payments is beyond me. ES, you know, estimated tax, right? So a lot of people pay estimated tax payments. So that's there for that. It might spar some questions that you have. So we are going to learn about tax planning basics, okay? And so it's always good to plan ahead and to preview any tax changes that are coming up before the tax year is finished. Because after January 1, if you had some plans you wanted to do, well, it's too late. So that's why I wanted to do this in 2023. And this is just a little bit about me. I've been doing taxes for a long time. You can read it in your thing. So after this class, we hope that you'll know how to prep for tax season, and that you'll know what records to keep and for how long to keep them. And hopefully you'll know more than you do right now before we're finished. And I hope that you will be confident, informed, and proactive to helping yourself save taxes. So we're going to talk about some tax tips and tricks, the important dates and deadlines, and what documents to look for, and also when they're usually mailed out. That's one of the handouts that I have here, so that you can see, oh, I'm going to be getting this form, and this is approximately the date when it's mailed or available online. A lot of places say, oh, you got to get it online. Oh, goody. We've got to be internet savvy with that, right? So then I want to talk to you about how to handle communication with the IRS. I've had a lot of people that just kind of put it aside and forget about it, and then a month later they find it, or they've gotten another notice from the IRS. And so we're going to talk about that. And then always just ask questions. Pop your hand up and get some questions coming for anything you want to know. So the thing that I consult with my clients is that when you owe taxes for the tax year, and you say, well, gosh, how come I owe so much more this year? I really didn't change anything, you know, the next year, so why do I owe taxes? And so a lot of that is because tax law changes. A lot of that is because the W-4 form that we fill out is really hard to fill out. How many of you guys have a hard time filling out the W-4? Trying to understand, what do they want me to put, right? I don't know. That's what people say. Because you can get online and say, oh, we'll do this and this and this. And actually, that W-4 form, you pretty much need to know what your income's going to be for the year. And it wants to, hi, come on in. and what your withholdings are, like if you have a spouse and how much they make, and you have this, and you know, you're like, oh gosh, I might as well just do my own taxes right now if they want me to fill out all this information, right? So it makes it really hard. So what I do with clients is I say, this is how much your taxes were this year. And we know the tax bracket that they're in, which it starts at 12, well, it starts at 10%, goes to 12, then goes to 22, then goes to 24, right? But that's not your effective rate. It doesn't mean all your income is taxed at 12% or 22%, because we have that graduating flux, right? So when I see that they owe taxes, or this is what their tax liability is, that's your tax. That's what you're paying the IRS. And then after that, what you've had withheld is deducted from your tax liability to see if you have a refund or if you owe more taxes. So look at what your tax liability is. Then what I tell people is look at what was withheld on your W-2. Take that figure, divide it into your gross wage, and that'll tell you the percentage of what is actually being withheld for federal. Do the same thing for state. Okay, I've had several clients where they're in the 12% tax bracket, their effective rate is 11.5 because the 10% is in there, or they're in the 22%, and then there's the 12, so their effective rate. So, and yet they're having 8% withheld for federal taxes. I say, well, right there, then you're underneath. You don't have enough being withheld to begin with. So we need to have more withheld. Nobody likes hearing that, but I'm sorry, that's how it is, right? So I'm trying to help people to not owe every year. So take that figure of what's being withheld, divide it into your gross wage, do that like in October or September and see where you're at, because then you have that last quarter to make changes on your W-4. Because the W-4 doesn't do any good to put one exemption, two exemption. That's old. That doesn't mean anything. And you can't even put down a percentage on the W-4. You have to put down a dollar amount that you want withheld, which is really crazy because if your wages go up during the year, they're still withholding that dollar amount. So, federal taxes, they'll never go into a flat tax because the rules that they have for it are too complicated. And somebody is going to be angry at something somewhere, so we're going to have lobbyists in there fighting for this and that. So, we'll never go to a flat tax. Of course, many states have, and Utah has. Then review your investment gains and losses. So you can say, hey, I've got some losses here I can take more of to offset. Okay? If you know you have a bonus coming, but your income is already high, see if you can have that bonus deferred to the next year if you're not going to be having as much income the next year. Or take some last-minute tax deductions. That's only going to work if you have a side gig, if you're doing some self-employed work and you can take another, buy something extra to help get your taxes down on that. You can make some extra donations, and that is, of course, if you're able to itemize, right? Everything with taxes is however or unless, because it's never a straight, this is how it is, it's always, could be something else involved with that. You can always contribute to an IRA. That reduces your taxable income. That's a traditional IRA. A Roth IRA does not reduce your current year taxable income, but what happens with a Roth IRA later on? You pull the money out and you're not taxed on it then. Neither are you taxed on the growth that it's had. Whereas a traditional IRA, you'll be taxed on what you put into it and all the growth. So it's a switch for what you want. And if you're able to have an HSA, a health savings account, put money into that. That reduces your taxable current year income. Okay. Now, can I get the Savers credit? Has anybody heard of the Savers credit? Yeah, this is kind of a fun thing. However, it's for people who don't make very much money. Okay, this is for, you have to be at least 18 and your income needs to be really high. You cannot be a full-time student. This is really good for ages 18 to 24. 18 to 24 is kind of like the no man's land for taxes for that age group. They're in between. They can either still be a dependent or they're not a dependent, and so you can't be claimed as a dependent. And the only way you can be claimed as a dependent in that age group is if you are a full-time student and you're not making very much money and your parents are still supporting you to somewhat a degree, okay? And you have to make a contribution into an IRA account, either a Roth or a traditional, okay? And then if your income is in this category, $21,750 or less, then 50% of what you put into that IRA account is a dollar for dollar credit against your taxes. Okay, and here's head of household and joint filers. They all have the same thing. And as your income increases, well, the credit goes down. So do you guys know the difference between a credit and a deduction? A deduction is, it just reduces your your taxable income. So it's a deduction, deducts from your income. And then you have your taxable income, and taxes are figured on that. A credit is a dollar for dollar reduction of your tax liability. So credits are always better. But then again, there's still a however or unless with credits, because most of them are not refundable. How's that? You have tax credits that are refundable or non-refundable. And we can get into that. So there's always something else. Okay, so here's just some dates. January 23rd is when the tax season will start, basically with the IRS. You can have your taxes finished and submit them if you want. However, they'll be waiting in a queue until that date when the IRS opens it up and the floodgates open and it goes in, okay? The deadline is still Monday, April 15th, 2024. We don't have any extension time on that. The extensions, if you file one, is due October 15th. And then refunds are generally released 21 days after the IRS has received your tax return. They are pretty good with that. The only thing with refunds is they pass, it's called the PATH Act, and if you are getting earned income tax credit, the EITC, or the ACTC, additional child tax credit, if you're getting that on your tax return, they will automatically be held, not released until February 28th. Regardless of when you filed them. That's just the way they've done that to try to stop fraudulent tax returns being filed. Somebody claiming all that to get a big refund, and so that just gives them more time to get some other information to make sure it's an actual tax return. And then if you're not getting your tax refund and you're saying, oh, where's it at? Where's it at? You can always go to where's my refund at irs.gov. Or there's a hotline you can call, but don't call them until it's been 21 days. Or they'll say, well, so sorry, Charlie, I can't tell you if it's not been 21 days since we've gotten it. So that's really good. Now, the IRS has a statute of limitations. So how long do I keep my records? I get that question all the time. 3 years is always open for the IRS, which means the current year and the 2 prior years are open. And that means they have all that time to examine them and look at them. And generally it takes 2 years for them to find something. But they're going through them. They're going through them. Now, so absolutely keep 3 years. I tell people keep like 5 years, but if they find that you have underreported your income by 25% or more, they can go back 6 years. Okay? And if they go back 6 years and see that it still had happened then, they'll go back and back and back, actually. It's fair game to the IRS, I'm sorry. Now, if you have a bad debt that you wrote off or a worthless stock that you wrote off, you need to keep 7 years because they can go back that far for sure. And then if you don't file a tax return or you file a fraudulent one, you need to keep your records to prove that tax return forever. Okay, now you say, well, if I didn't file one, how come I have to keep my records, right? Well, because the IRS is always checking things, okay? They may find that, hey, you didn't file a tax return. They get records of all of the things that are on that, what forms that I'm to expect when the handouts, you know, all of those forms, the 1099s, the W-2s, all of that. The IRS gets copies of them. So if you don't file a tax return and they go through that and they say, hey, there's taxes owed on here, they will for sure let you know you didn't file a tax return. If you don't file a tax return and they go through all of that and say, hey, you had a refund coming, they just stuff it under the table. I'm sorry, you don't get the refund. You have to ask for that refund, and you have to ask for it within the 3 years of being open, or they get to keep it. They don't, you know, that's just how it goes. So I always say, it says voluntarily file your taxes and file them on time. So if you file your taxes late, that's as if you didn't file it at all. So you better keep records forever on that one. It's always open because you didn't follow the rules. So I've got several clients, not several, a few, that like about every 5 years, okay, we're ready to file our taxes for the last, you know, I'm like, are you kidding? No, it's important to file your taxes on time. Refund or no refund, just so you can have a closed year. I don't want it that open. So here's new with Utah State. We started at 5%. Then it went to 4.85%. 2023 tax rate is 4.65%. They give us things in little increments, okay? The solar panel credit. How many have heard of all that?
Is this different than like the solar, I saw it in here, the solar credit? This is different?
No, this is the same thing.
The solar tax credit?
Yes, yes. This is the Utah State.
Oh, I see.
Yeah, the federal gives you that credit like they do. This is Utah State. They give you a $400. And then in 2024, it's zero. The solar phase has gone out. Utah has not always given the earned income tax credit, but they did last year and they are this year. And it's 15% of whatever your federal earned income credit is. So we get in a little bit of increment with that. Retirement credit has been around for a long time for people who are getting pensions or retirement money. IRAs are considered retirement money. But that one, very few people are able to get that because it's under the same income that the IRS gives. Of if you are a married couple and you make more than $32,000 for the year, oh, your chance of getting the retirement credit is zilch, right? Social Security income tax credit is new. It's actually started in 2021, little bit. So that income, though, if your income is $75,000 or less for married filing joint, you're likely to get a credit on whatever tax your Social Security caused. Okay, and then here's one that's fairly new for the state, and this is the pass-through entities. That you can have your business, if you are an LLC, not a single-member LLC. I'm talking about partnerships or S corporation. If you are a partner in a partnership, that's a pass-through entity where you get a Schedule K1, to show the income on your tax return. That entity can pay your state personal income taxes for you, and you get credit on your personal taxes for it. It's also deducted as an expense on the partnership, so you're deducting it from your income. So that's a really good win, and that came about when the IRS decided that they're putting a cap on what we can deduct as itemized deductions on Schedule A on our personal taxes as far as state taxes go. State taxes are our property taxes, taxes withheld on our W-2s, any additional state tax that we paid, all of that, and it's capped at $10,000. Anything more than that, not a deduction. So if you know anybody has the pass-through entity, make sure they know that. It's called the SALT payment. So that's a really good thing. So now we're talking on here about how long to keep records for the assets that you have, such as stocks and bonds, your home, and all the improvements that you made on it. Because when you sell, well, stocks and bonds, can come on your 1099 DIV or those forms, right? But it's always good to keep a record of it yourself, but always keep that. So with your annual stock papers, you get your quarterly statement, right? Always keep the year-end statement. The first 3 quarters, you can shred those. The fourth quarter will have everything for the year. And you want to keep that for as long as you keep the records for your taxes. But on your home, I mean, you may not plan on selling your home for quite a few years, right? So, but keep the records of your purchase on that. Yeah.
So with that kind of stuff, so I went in and did my taxes a few years ago, and my tax person made fun of me because I brought in my little baggie of all my receipts and stuff because we did a big home remodel and our business deductions. Is that actually necessary? Because they said because I also use the self-employed QuickBooks app where you sort your debits to, oh, this is personal or this is business. If I were to get audited, what level of detail are they looking for? Are they looking for each printed receipt, or would that spreadsheet of the sorting of expenses, would that suffice?
That would suffice.
The digital version?
It would.
Okay.
And it's hard to keep receipts. You know what happens with receipts after a year or two?
Yeah, they lose all their color.
Yeah, they're like, oh, I swear that said such and such on it, Yeah, it fades. It rubs off whatever. Scan it.
Okay.
Scan it. Just keep a digital copy of it.
Okay.
Then you have that. But if you have it on an organized, see, that's the thing with organized, with keeping your records, the more organized you are with keeping your records.
Because the QuickBooks, it just sorts it by the dollar amount. So it's Home Depot, $75 or something. It doesn't have itemized each thing goes per. That's not necessary.
Not necessarily,
Okay.
but still, if you kind of jot down, if you know what it was.
Okay. Because I think there's the spot to take the pictures of each receipt, but I'm ooh, that's a lot of work. I haven't ever done that.
I know.
But maybe it would be helpful.
I know.
Just in case.
Yeah.
It's good to know.
Yeah, it is. And right now, and we've had this for a while, we've got the Section 121 exclusion, and that is when you sell your home, married joint, what's the exclusion for capital gains? $500,000. So if your gain is less than $500,000, all of this is really not all that important because it's not going to be taxable to you. But single, it's half of that, $250,000. But if you turn your home into, at some point, a rental, okay, you need all of that. Because when you have a rental and you sell that, you're going to have capital gains. The primary residence exclusion is out the window. However, on a personal residence, the rule is 2 out of the last 5 years that home must be your primary residence. Okay? When you turn your home that you've lived in for 15 years into a rental, and you rent it for 2-3 years, and then you want to sell it, do you qualify for that 2 out of the last 5 years? And the answer is no.
Really?
And that one was kind of like an eye-opener to me, too. It's like, well, I've lived in it forever. But when you turned it into a rental, now that 5-year clock started over again.
How do they track that? How do they know How do they know? Are they like peeking in your window to make sure? Like,
I know.
But really, how
So
do they know
true.
that?
How do they know that? Well, your tax return will show the rental for when you started it, and there's a starting date when it started renting. You know, and I have done some that they rented it for a year or two, but I put it through as qualifying. However, you know, for the bigger part of the exclusion, but not all of it is excluded because you did have 2 years of renting it, and the depreciation deduction that's part of renting is one of those deductions that is deemed as being taken, whether you literally took it or not. So that, and you can't, so that, you know, you have to count that depreciation part of your deductions as income the year you sell it, if it's your primary residence. And that goes the same thing for business use of home expense. The same thing. So whenever you have that you are counting as your primary residence, but you have used a portion of it for business, okay, they're two different things then. You have to treat them differently. Yeah. And then, of course, you know, business furnishings or equipment, keep the receipts and all the information on that, because those kind of things are a depreciable asset. Where, and you understand what depreciation is?
Loses its value?
You take a portion of the cost every year to write off instead of all of it at once.
What's an example of that, Claudia?
For business, you know, a copy machine. So you can write all of it off at once or depreciate it. Okay, it's not a set thing. In fact, we've had a thing called bonus depreciation for the past few years, to where it's automatically a bonus, 100% bonus write-off. Well, for 2023, that bonus depreciation is now 80% of it. No longer can you take a bonus depreciation of 100% of the cost of that asset. Equipment would be like a tractor, like a, you know, things like that. So when the bonus depreciation, when we didn't have bonus depreciation, you could still write the entire cost of that off, but it was called a section 179 for depreciation, in which you took all of it. And there's some special rules with that and such, that you could never put yourself into the negative on a business, or, you know, refundable, no, you know, that kind of thing. So, now, if you get a letter from the IRS, it does not always mean it's bad news. We've gotten some letters that are saying, oh, you get this much more because whatever, you know. But there are 76 different form letters that you can receive from the IRS. And if you want to look them up, there you go. You can look them up, all kinds. But if you get one and you don't know what it is, seriously, look it up and say, what does this mean?
I think I texted you this summer because I got a weird, and I think it was a scam, but I was so stressed and I couldn't find it on there. So anyway, just email Claudia.
I'll tell you. And then always deal with it promptly. You know, because if you put it off and you think, oh, well, I don't know what this is about, and you're busy, right, and you set it aside, and then, you know, you get it or whatever, and don't wait till you get a lien letter saying, okay, now we've put a lien on you because you owe this. And if you don't respond, and it's something that, I mean, they make mistakes, okay? You don't ever take what they send you as pure fact and send in the money, because there's a chance that it's not. In fact, I've got one right now that I'm dealing with that I know that they have to prove to me why they think it's $170 more, because it's not. So, and that has to do with, because this is when I actually had to mail in. We couldn't e-file it, and it was a big tax return. So that's why you always want to e-file. When you e-file a tax return, it goes into their computer system. Nobody else touches it by entering in. When you mail in a tax return, somebody there has to sit down and input that tax return into their system. So I know, well, without checking with them, because I can't get a hold of them yet, that somebody put in something wrong. So it made it look like. But because, no, I know, I've checked it. So, and then when you get a letter from the IRS, don't give them a whole bunch of information that they're not asking for. You know, all they're asking, just whatever they're asking for, you just answer that directly and don't say, oh, well, gosh, we've done this before. Why are you questioning this now, right? Oh, no, don't ever say that. That just opened up a few years prior to you. You know, and it's honest. I mean, we can make honest mistakes. But, you know, but just follow their instructions, deal with them quickly, don't let them. If there's a question on it and and they're like, hey, a lot of times they just send you something saying, well, we think this and this and this, they don't say think, but they and if you can't give them an explanation as for why it's not that, well, they'll go through and do their own computation and then say, okay, this is what you owe us now. And don't let it get to that point, for sure. Oh, see, and then here again, it's on that. I keep doing this. Keep good records. So the more organized you are, the faster you'll be able to come up with the document that they want and get it to them. Just get it to them. And then they even have that where whether they want it in hard form or electronic form. They have gotten a little bit better about being able to upload documents to them. I don't know how many people are interested in cryptocurrency. Yeah, cryptocurrency. Okay, so here's the tax myth number one. It isn't taxable. Oh, yes, it is.
Yeah, my dad found that out the hard way.
Oh, dear. Oh, yeah. Yeah. And then you think, well, the blockchain is fully anonymous, and the IRS can't trace your crypto transaction activity. Is that true? Oh, no, they can. They can. They don't do it as well as they want to, but they absolutely can. And then, you only have to pay taxes on a 1099-B that you received, right? No, that's not true either. Because at the beginning of cryptocurrency, they didn't issue 1099-Bs. And most places still don't. But the IRS has been saying, hey, we want you guys to get out these 1099-B forms, because that gives you a better idea of purchase and sale, right? But it's always good to keep track of it yourself. Don't rely on a form.
Isn't it if it stays in for a certain amount of time, when you pull it out, then you don't have to pay capital gains? Or did I misunderstand that?
Cryptocurrency is classified as a property. It's not classified as stocks, bonds, but it is classified as property. Therefore, it's taxed the same as capital gains. So that is where you're taxed. It's capital gains, and so the same rules apply to that.
It stays in for 2 years.
It's long-term capital gains.
So it's just less.
Yes, yes. But it's never, oh, you don't have to pay taxes on it at all. No, we're still trying to get that, right? Yeah. It won't work, yeah. So, yeah, if it's under a year, it's taxed as ordinary income, which is whatever tax rate you're at. So if you've hit the 22% tax bracket, you're going to pay 22% taxes on that. But if it is held longer than 2 years, then you're going to pay the 15% capital gain tax rate. And then the last myth is if you hold it through a private wallet instead of a crypto exchange, you don't need to report the capital gains or losses. Not true either. So any form of cryptocurrency, Bitcoin, whatever, it is taxable. In fact, in 2021, they started putting in the question of, do you have any dealings with crypto, with virtual currency? And then 2022, they had that, and then an extra question of, do you have any foreign bank accounts and things like that? And it's all supposed to help with money laundering. And I'm not going to say anything more about that, or I'll be... Okay, so short-term rentals, okay? A lot of people like to do the Airbnbs. This is for the state. You have to have a transient room tax and a sales tax for short-term rentals. You have to charge them that, and you do have to file a return with the state for that sales tax and the transient tax. And then not all the counties or cities in Utah allow short-term rental. I looked this up, and Salt Lake City only allows 30-day rentals.
Yeah, very few actually allow Airbnb at all.
Mm-hmm.
They just don't like
They-
prosecute it, so
Right.
people do it anyway.
They don't prosecute it. But I did see on there, if they do find it and that, it's a misdemeanor C.
Really?
Yeah. So, but yeah, they don't like that. And also when I was reading up on that, it was saying you're supposed to get the approval of places around you if you do that. You know, so just be real careful on those. And then not all short-term renting is taxable. When is it not taxable? Right there. If you rent out a room in your home for 14 days or less, maximum 14 days, you don't have to count that as income. You're not counting any deductions either, right? So if you're in an area, I was reading this, where they're having the Olympics or whatever, a special thing, and a lot of people are coming in, you're like, oh, geez, it's going to be crowded here. I'm just going to leave for 2 weeks and let somebody else rent my house. There you go. Tax-free income to do that. You have a vacation home. If you live 14 days or more in that vacation home, then it's not considered a rental. So the rent that you're getting from that is not taxable to you, nor are the expenses. Okay? But say you live in it, you don't rent it all year long, you just rent it a little bit. So that's where the 10% comes in then. You have to have lived in it for at least 10% of the days that you actually rented it. Okay? And Venmo, PayPal, and these other third-party networks, when I did this slide, as of November 14th, it was still that those 1099-Ks were going to have to be produced. A week later, got news, no, they're postponing it again. So if it's over $600, and a lot of these places have started doing 1099-Ks. So if you do an Airbnb and you are going through a third-party network to handle that, they may issue you a 1099-K. And if you did it for less than the 14 days, you want to keep records to show that you don't have to count that as income. Because if you don't put it on your tax return, guess who gets a copy of the 1099-K? The IRS. And they'll say, hey, you didn't report this as rental income, and you say you have to have your records to show it was 14 days or less, but it was more than $600, so this place gave me a 1099-K, because that's the rule. So you want to be careful with all of that. Now, long-term rentals. Okay, again, I already covered you purchase a home or a condo or whatever, and you have it to be a rental right from the get-go. Then there's a lot of things on that when buying it that's deductible, okay? But of course, the building itself, the home itself, has to be depreciated over 27 and a half years. The land value of that is never depreciated, because land doesn't depreciate. You convert your home to a rental. Same thing I was saying, when you sell it, yes, there's capital gains that will be paid on when your home that you lived in turned to rental. And then, of course, the long-term rental that you've always had. There is a way when you can postpone that. Who knows what that's called? You have a rental home. You want to sell it, but you don't want to pay capital gains taxes on it. So you're like, gosh, what can I do to not pay capital gains taxes on that?
Move back into it for a couple years.
What's that?
Move back into it for a couple years. Have it be your primary residence and then sell it.
You can, yes. Oh, that's the one. Thank you for saying that. So it's not turning your home into a rental, the 5-day thing works. It's having a rental, converting it to your personal residence. That's the one that has to be the 5 years. So loop back and take that. That's the one where it's always been a rental. You move into it, you're like, oh, I just have to live in this for 2 years, and then it's my primary residence. That is not true, because it's not, that doesn't meet 2 out of the 5 years. So you would need to live in it for 5 years to be able to use that as a primary residence and get that capital gain exclusion. The other way is, say, well, you still want to have some rental income, but you're tired of this rental. You can find another rental and do a 1031 exchange. Right. And that way then you sell this one rental and you have that income, but you have a mediator that's handling all of this, because you can't have access to any of that money for it to qualify as that 1031 exchange, and then you move it down. So that's what that does, is kicking the taxes down the road. You will eventually pay the taxes on that, unless you do turn it into your primary residence. So what's included in rental income? Well, the deposits for the last month's rent is, what about that security deposit? Do you have to count that as income? Not necessarily. I have a lot of clients that just do, because they don't want to have to worry about, well, did I count that as income? And now they're leaving and I gave it back to them, but they don't remember, right? So we count it as income, but you don't have to if you know that more than likely you're going to give it back to them at the end, okay? And then what is deductible? Well, anything that's ordinary and necessary. You look that up at the IRS, that's what they say all the time. Ordinary and necessary. And they do track different types of businesses and keep track of what people have over the years, and this is ordinary and necessary. So if somebody does something that's weird and out of place on it, they'll probably audit you. Just because they keep track of all the different kind of things. And then what else is a deductible is the mileage. If it's a local rental, your miles for going to places, to the rental, checking on it, to anything you do for it, the mileage is what's deductible, not the vehicle. But if you have a rental that's out of state, and you have to fly there, okay, well then that airline cost is deductible. If you have to get a rental while you're there, it is deductible. But if you go for multiple reasons, not just to check on the rental, you have to keep very accurate records of how much time was spent for each. Will the IRS know? Maybe not, but if you have a huge expense in there for something, it triggers them. It gives them yellow flags or whatever. So big difference between improvements and repairs. So a lot of people want to just write off everything, right? Well, I had to repair this, I had to repair that. Okay, but does it qualify for 100% write-off like a repair is, or is it an improvement?
Give examples.
You have to repair your roof, and you think it's just a little spot. But then you get up there and you find out, oh my gosh, I have to replace nearly the whole roof now. It just turned into an improvement instead of a repair, because it prolonged the life. It made it to a new state, and it was more than just a little section. So now that roof now has to be depreciated over minimum 20 years, maybe 27 and a half, just like the original building did. If you have to rewire the entire house, that's an improvement. So we have to watch for those things, but little things here and there, that's fine. And the little things could add up. Sure, it can be a big expense, but you have to know if it's actually putting it back into a substantially new state, or if it's just repaired that, to get it going. You buy a brand new refrigerator, guess what? That's depreciable. So it has to be depreciated. Not over 27 and a half years. Whew! Whose fridge lasts that long? No. Okay, so can you claim a loss from rental activity? I have people ask me that all the time. Yes and no. Like I said, it's never a one-way answer. It's a maybe, because there is such a thing called the PAL rules. What's PAL? Passive activity loss. Rentals are considered passive activity, which means, which is odd, because you work doing that, right? But forget that IRS that I said that's odd. Let's leave it like it is. But they do qualify that as passive. That means that the net income from a rental, you do not have to pay Social Security tax or self-employment tax on that income. It just goes through as just ordinary income. Whereas if you are doing work and it's on a Schedule C, you have a side gig and you have a net income, you're going to pay self-employed taxes on that. So, are we running out of time?
We have 13 minutes.
Oh, okay, good. Okay, so you can write off about, the maximum you can write off is $25,000 on a rental. But you cannot get up to the $25,000 by, you can't take Section 179 on things that have to be depreciated over 27 and a half years. Okay, so you can't get it that way. The passive activity loss rules will apply if you're renting a home to one of your kids and you're giving them a really good deal on rent. So they're not paying the fair market value of what normal rent would be for that. Well, then you can't take a loss on that rental. Because as a rental, you get to write off, if you have a mortgage, the interest, the property taxes, whatever else you're having to pay, if it's a condo, HOA fees, things like that. Well, all of that will add up and can cause a loss. So no, you cannot claim that as a loss. But it doesn't mean it's gone forever. What it means is it goes over to a different area and it's held and it accumulates and carries forward year after year after year. So down the road when you sell that rental, guess what? All those passive losses now come forward and will help in reducing your income on the sale of that. So, look at that. With all of that, and I hope it's not more information, or what do you want to know other than what I've talked about? Because there's so many areas, you know,
What are
in taxes.
the main things that will cause red flags for like audits?
The main thing, well, you will always, let me rephrase this. Audit letters, people get, they're called notices, okay? They're like, oh, I'm being audited. Not true. Everybody, so many people get things called CP 2000. Do I have that up here? I thought I did at one time. Yeah. Oh, those are so common. And those are just because they send something out saying, hey, this was missed on it, or this was missed on it. So if you're doing your own taxes and you have left something out that is crucial, and I'm trying to think of what that would be, but they're like, don't misspell your name. Just addition problems. Just saying, hey, this wasn't added correctly. Okay, so everybody gets CP 2000. The thing that does, in my opinion, bring up big chances for being audited is if you have a self-employed business and all of a sudden you are reporting, you know, a $50,000 loss on it. Okay, that's a red flag. They'll look at it more. They've got 3 years to look at it, to examine it and see, is this legit or not? And like I say, they track all the different areas of work, industries, what do you call them, you know? And they say, this is common in construction. This is common in real estate. This is, you know, but if you have something that's out of the norm, then they will more than likely, you know, want to find out why. And it doesn't mean that you did it wrong or that it's wrong. That's, again, good records. Always keep good records. Say, well, this is what I actually really had. But if you have a huge expense for travel that one would be like, okay, so did you go on a family trip? Did you take the family? Did you take your spouse who's not even involved in the business? You can't deduct things for the spouse. You know, his share of the airline ticket, you can't deduct that. They do look at things like that. So always just be sure of what you're putting down. Don't be afraid, just be sure. Just say, I've got the records. Here we go. Bring on the audit letters, right? So many people get those and they just go, oh no, I've got this letter from the IRS. I see them like, what are they saying? And then I'm like, well, okay, let's just fix that then, right? Nobody's perfect. Nobody's perfect. So, yeah, and that's, the good thing is that the standard deductions are going up every year. The tax brackets, more income into them to, before they're taxed at that rate. So they're short on employees at the IRS. That's why it takes so long to get somebody in there. They've since COVID, and they closed everything down. Well, nobody's wanted to come back to work, and they can't work at home for the IRS. I don't want them taking my stuff home, right? Yeah, so it's, but they said they put in a lot of money and supposed to be getting the employees back to get better customer service, so I have to.
I'll believe it when I see it.
Me too. Hasn't happened yet. So, yeah. So any other questions? Do you think there's a certain age? How old do we have to be before we don't pay taxes? I get asked that all the time. How old do you have to be before you don't pay taxes? And I said, well, let's see. My client was 99 last year, and my client. It's not an age. It's not an age. It's an income. It's an income. And honestly, the biggest complaint that I have has to do with that retirement credit that nobody ever gets, because it's been, the threshold is if you make more than $25,000, a single, $32,000 married, your chances of getting a credit on that are slim. Well, guess what? It's been at that for 50 years. Where's the cost of living increase with that? And that's the same figure that's used for whether Social Security is taxable to you or not on the federal. The state, now it's $75,000, and from what I've been reading, next year, 2024, it won't be taxable. So yay, you're not going to be put on the list of not taxing Social Security, but no, the IRS, oh my gosh.
It's crazy. They're taxing their own, that doesn't make any
They have a reason. It's a good one, they say. So Social Security is taxable starting at 50% of your Social Security income. No, they call it a benefit. They do, they call it a benefit. Okay, I paid in, my employer paid in, so the employer paid half, we have half of that taken out of our paycheck. And our gross wage includes all that we're paying taxes on, right? Right, but half of that our employer paid, not us. So they have the right to tax us on 50% of our Social Security because we did not pay taxes on that. We did. I just said the gross amount included both. I mean, it's crazy, but they do that. So, yeah. And they won't tax you on more than 85% of your Social Security benefit. So, I know, it's... Exactly, yeah. So, anyway, I hope you have felt like you've learned something. Keep in touch with us. If anybody has any questions, you're welcome to email me. This is our utah.myelysium.com because we have a branch in Arizona. So if you just look up myelysium.com, you'll get Arizona. So, but it's great that we have that. And yeah, if anybody has any questions, like like Janessa said, email me, text me, whatever, and I'll see what I can do to help.
That was awesome, Claudia.
Oh, thanks.
Such a great